In this video, we're going to discuss the balance sheet. In part one, we'll talk about some general structure issues, and then we'll discuss the asset section of a balance sheet. The statement has had many names over the years. It's been called a statement of condition, statement of financial position, right? Essentially what it does is it takes a picture of the company on a particular date. Now this date is what's referred to as the fiscal year end. You and I have a fiscal year end. It's December 31. Most companies also have that same fiscal year end. However, that doesn't necessarily have to be true. A company can set the fiscal year end based on maybe necessity. For instance, maybe a toy store would want to have a fiscal year end that's in April, when sales are typically a little bit slower. Inventory is evened itself out a little bit. There's less inventory after the Christmas sell-off. So a company can set that date whenever it wants. But essentially, a balance sheet sets out or describes what a company owns. That is, what assets have they purchased to do the thing that they do, to run the business itself. The other side of the balance sheet then talks about where did the money come from to get the assets that the company is using. So there's really two parts to the balance sheet. What assets does the company own, and where did it get the money to get those things? That where did they get the money is another way of also saying what money does it owe to its outsiders, to the creditors and to the shareholders of the company. We have what's referred to as the accounting equation. It's assets equals liabilities plus stockholder equity. These are the assets the company owns. The liabilities are what the company owes to its creditors, to its outsiders. Stockholders' equity is what the firm owes to its internal owners. This represents the shareholders' net investment in the company. So again, as we go through this, we'll talk about some of these components, some of these pieces. What happens when companies combine together? Well, typically, if a company owns more than 50% of the voting stock of another company, those financial statements of those two companies are combined together in what's referred to as consolidated statements. The reason for this is because the companies are in substance one company, right? So essentially what we're saying here, when you see something that says it's a consolidated statement, you're looking at the statements of what might actually be two companies together. So what if a company owns less than 50%? What if you only own 30% of the company? Then you would be identified as being a minority interest. So again, we'll maybe see this if we look through and you look through different company annual reports and financial statements, you will see minority interest. You now know that is our investment in another company, but we don't have 50% of the ownership. A common size balance sheet looks at the line items of a statement, and it calculates each line item as a percentage of total assets. We would like to look at what relationship do these assets have to each other. We can look at, if you think about a vertical thing, right? We can look at within this particular year, what is the relationship? Of course, horizontally, we can look and see if there have been changes over time in these ratios. So what we would like to be able to look at is some trends, right? Maybe we want to compare these numbers to competitors or to the rest of our industry. So let's think about, in general, assets, right? There's current assets. They have a lifespan of less than 365 days. We have plant and equipment. Part of this plant and equipment is depreciation. Typically, you'll see this listed as net plant, property, and equipment. That means they've already taken out the depreciation and amortization. We have other assets to talk about. These other assets, some of them will be tangible, that is, some of them you can touch, but others will be intangible. Things like goodwill, trademarks, you can't touch those things. They have value to the company, but you can't touch them. So here we have the total assets of this company. If you look at the current assets, $65,846 in 2010, $56,264 in 2009. Obviously, you can see that current assets have increased. If you look down below here, you can see that there was a fairly substantial increase in the net property and equipment of the company. So we have purchased some major assets. You can see here we went from equipment went from 13 to 21, and buildings and leaseholds went from 11 to 18. So we've been buying things. We've been purchasing large, long-term lived assets. So this company apparently is growing. We're expanding our asset base. So if you look at another company, this happens to be a picture of Coors. And the numbers are a little bit on the older side. I understand that. But let's just think about the relationship of these numbers, right? If you look across the line item, here's cash, accounts receivable, inventory, miscellaneous. These are all assets that have a lifespan of less than 1 year. Below that, we have identified our net fixed assets and our intangibles. Now, there are always some other things that may fit into some other categories, right? And you can see that over the time span, that numbers have been fairly large from time to time. But we really want to be able to pick out primarily fixed assets and intangibles. Those are the things we really want to analyze for the company. So this plant, property, and equipment, right? We want to talk about the fixed assets of the company. We've already talked about tangible, that concept. They're real. You can touch them, right? From time to time, right, we know that assets are used, right? But plant and equipment, they take time for that to happen. It doesn't happen in 1 year. And in fact, they often refer to as the economic benefits from these assets. The definition of fixed assets is that the benefits come to the company over 1 year. So they take time to come in. So as you can see, if you look across different industries, there is a vast difference in the percentage of fixed assets for a particular industry. And you can see here that for pharmaceutical preparations, right, 24% of the assets are plant equipment. 23.6% is household furniture. On the other hand, drugstore, right, the wholesale drug industry is 9.7%. Retail pharmacy size, 12.8%. So as you can see that the different industries may have different percentages of plant and equipment. Now, is this a choice of the company, or is this a function of the industry you choose? The amount of plant and equipment you have, to a great extent, is chosen by the industry that you're in. Now, you can increase that by expanding operations, by mechanizing plant and equipment, by going to more robotic kinds of operations, if you will. So again, if we come back here and look, right, here we can see what's happened to plant and equipment for Coors. You can see that over the years, there was a fairly substantial increase. Now, in this last year, 2008, I'm not sure, again, we might want to look at this, see why has it fallen by half. It turns out in 2008 that they sold off a major component of the company. Since 2008, they have expanded this company manyfold by purchasing into Miller, and also by into Molson was another part of their arrangement. We can also look at these other assets, right? Other things. These could be long-term investments. They could be the startup costs with a new business, right? Property that's currently being sold is expecting to be sold, right? So this, we don't want to show this as plant and equipment, because in the near term it's going to be sold away from the company. Parts of these other assets are the things referred to as being intangible assets. Goodwill comes from the combination of businesses. So this item is created when we buy another company, and that company is purchased for more than the value of its assets, right? We're going to book, remember when we do a consolidated statements, we take their financial statements and we melt them into our financial statements. But if we paid more than what their book value is, which we frequently do, we need to account for that difference in value. That's what goodwill is. And of course, these other things, I'm sure you're familiar with, that these are line items or items that the company holds that have value but cannot be touched. And again, as I mentioned, goodwill, right? It's a very important piece of the company because frequently it's a very large piece. Eventually, as time passes every year, we will write off this goodwill so that as these assets were purchased, right, the value was booked on the accounting side. This extra value is going to come to the company, if you will, or be written off as these assets are used throughout the lifespan of this new entity that we've created. So again, that is a brief but kind of a detailed explanation of assets on a balance sheet.